Well, I think it's fair to say, looking back over the past year, that hardly any of the analysts expected as strong a year as we have seen across all the major asset classes, some of them posting some of their best years in decades even. And while we expected a strong bounce back from the overreaction that markets had exhibited in 2018 towards the end of the year, we were taken by surprise ourselves with the strong rally that kept on going through the year. What was behind that? Clearly, central banks played a major role. They made an about face. They turned around 180 degrees and have provided huge amounts of liquidity, as hasn't been seen since the depths of the global financial crisis in 2008, 2009. And that has helped things along. A lot of the gains that we have seen, especially across markets such as equities, haven't really been underpinned by commensurate moves in the fundamentals. On the contrary, we have seen falling corporate profits over the past year. European equities, their companies have seen declining earnings by as much as 5% over the most recent quarter, Q3. In the US, it was about 3%. So clearly, it has been liquidity and multiple expansion that has been driving this strong rally. And we believe, against that background, that next year will require a lot more selectivity in order to be successful as an investor. In particular, what we believe will be quite a bit more difficult next year is to find sources of growth for the world economy. There's quite a bit of enthusiasm baked in already after this past year, but not really due to the fact that indicators are looking up strongly. On the contrary, they've been on a downward trajectory. If you look at leading indicators of the PMI all through the past year, they've just recently shown some tentative signs of stabilization. But even the usually quite optimistic projections of some of the large organizations such as the International Monetary Fund or the OECD suggest that at best we'll get growth slightly above 3%. And there are some warning signs on the horizon that suggest that even those objectives might be quite optimistic. Looking at China, for example, they've really been what has been pulling us back from the brink whenever we have seen the global economy weaken over the past 10 years already. They were instrumental in getting us out of the global financial crisis, that deep recession there. And ever since, during the Euro crisis, 2011, 2012, most recently in 2015, 2016, it has been Chinese credit creation that has helped keep our Western economies out of recession. Now, this time around, this Chinese credit impulse is fairly weak so far, and there are suggestions that China might be coming to the end of their abilities in terms of structural impediments to significant further credit creation. Leverage has gone up tremendously in China as well, and if this helping hand is not around this time, it might actually end up with some of our Western economies going into recession. In Europe, Germany, for example, already has basically lost all dynamic momentum, scraping along a 0% growth rate. In the US, there was a lot of fear about an impending recession over this past summer. That has subsided completely, yet the re-steepening of the yield curve that we see in the US has historically been a sign of exactly an impending recession and should not easily be dismissed. A more pessimistic outlook is in particular supported by what we see in the bond markets. Those have seen falling yields all through the past year, and the most recent recovery has been a lot more tepid than the break to new highs that we have seen in the equity markets. We remain in the US as well as in the European bond markets below the levels that prevailed before the breakdown of the past summer. And historically, it usually has been bond markets that have had a pretty good nose when it comes to sniffing out weakness, and they continue to point to economic weakness despite the much more optimistic sentiment that prevails across markets currently. We believe next year is going to be a bit more difficult and require selectivity. For one, in terms of regional exposure, interestingly, emerging markets have been lagging again, as they have over the past 10 years already, their developed counterparts. We believe that this stretch of underperformance is coming to a close, especially now that we're seeing signs of a weakening dollar, and valuations across emerging markets are quite attractive. And on top of that, policy room to maneuver is much more pronounced there than in developed markets. There's fiscal space for accommodation. There's space for accommodation on the monetary front as well, especially with the US Federal Reserve on in a hold pattern or seeing further declining rates. Even as far as sector exposure is concerned, despite the strong rally that we have seen, there are some sectors that have not really participated and are actually quite beaten down. In particular, the energy sector comes to mind, as well as the broader material space, and there we believe that some bargains can be found. In addition, European banks have shown abhorrent performance over quite a few years already, and for good reason, given the difficult fundamental state of the European banking system. But it has gone to such extremes that we believe that some bottom fishing may be indicated here, where we would step aside and take a distance that is in some of the most highly valued sections of the market. In general, US equities are extremely expensive, but within the US, technology stands out as approaching levels that we have last seen in the dot-com bubble of the early 2000s. And there we wouldn't be surprised if also some of the political risks that are latent there in terms of breaking up monopolies that have evolved due to network effects over the past 10 and 20 years already, if those kinds of forces wouldn't put an end to some of these very high valuations that we have been seeing there. Commodities should do quite well next year, again, provided that global growth holds up at a level of above 3%. Energy has been the best performing sector over the past year. We believe that the upside potential, despite all the support that the sector is getting from OPEC production cuts, is not going to propel crude oil prices significantly higher on a spot basis. However, we have very strong backwardation across the curves in the sector right now, so it remains attractive from a total return perspective for investors to maintain exposure to. We believe that some of that uncertainty will be lifted, which might translate to a better outlook for grains in particular, soybeans, for example, in the US, but also the meat sector, given the issues in China with African swine fever. There's a big potential for US lean hogs exports, for example. All of that might help agriculture along, especially given how much it has lagged in recent years, as well as base metals, where calm on the trade front between US and China should help some of the rather depressed prices that we are seeing there right now. Apart from energy, gold has been one of the standout performers among commodities over the past year. Gold has broken out after a long consolidation into a new uptrend. We believe that there is a good chance for this uptrend to be extended into next year. It has primarily been a story of falling interest rates supporting gold prices, apart from political uncertainty surrounding the trade conflict and other geopolitical issues. those have been pushed into the background for the time being, but could re-emerge at any time. As far as the interest rate support is concerned, especially from real interest rates, we believe that this story continues. Inflation expectations have dropped significantly over the past year, despite the fact that spot inflation has been quite lively. In fact, CPI core inflation in the US is at a 10-year high. This divergence will close eventually, and even in an environment of stronger growth, should it come to that, we believe that the catch-up in terms of inflation expectations is going to keep real interest rates depressed, if not even falling further, which suggests that gold positions should be held and added to into weakness.